what you just said is remarkable because I don't think I've heard anybody else say that the reason why our culture is so against life insurance is because we never received it. Right. Like,
so we don't have an emotional connection.
Yeah, we don't believe that it can actually work for us. And that just for me, so my father passed away when I was 16. I'll never forget. He had the life insurance through his job, which is a trash plan. Yeah. So it was like $25,000 in life insurance to pay for his funeral and to get split up amongst 3 siblings.
Right.
So we got like $4,000 each. And I was like, my father just passed like a fourth of it. I'm doing $4,000. You know what I'm saying? And so I just realized that the probably reason why I was jaded, to think that life insurance wasn't something that was immediately necessary. If I would have got $100,000, if we would have got $100,000 each, it would have been a different story.
Imagine getting $1 million, tax-free, a check. Your bank account might have been at $5,000. It's at $1,000,005 Do you understand? I think we're not really letting people feel what it would be if this was to happen. Because I've had people say to me, nobody left me anything. So I'm not leaving my kids anything. And I'm like,
crazy.
What?
Yeah.
Because I don't understand. Just because you didn't get the feeling, why you don't want to leave the feeling behind?
Right.
Yeah.
So I think that one of the other issues are there's too many people talking about life insurance that are not licensed, don't know nothing about it, have not experienced receiving the money, and they're giving these opinions and people are thinking that they're facts.
Right.
So one of the things, because I have a mentorship where I mentor agents, and one of the things I teach them is, listen, you want to treat these people like as if it was your family. And so if that's the case, you need to make sure that they understand the feeling of what they're doing, what this is going to do. And so one of the things I think with all of these opinions, you got people telling you buy term, invest the rest. You got people telling you you don't need insurance. You have people saying insurance is a scam, all of these things. And you know what I tell them? I say, guess what? That's your family and your issues. I'm going to tell you this. When I pass away, my daughter's going to get over $8 million in life insurance money. And she also has her own policies that were going to be paid up that my grandkids will receive money for. I've used my insurance when I've had hardships. I've used my money to renovate my house. I've used my money for so many different things. She's about to go to school. If I need to, I will dip into it. You understand? So I've experienced it. So I don't understand what's the scam part about it.
Right.
I don't understand why you would tell me to buy term and invest the rest when half of us are not investing.
Right.
They're buying the term. Yeah. They're not doing the other side of it. So that's why you can't tell our community that, because they don't understand investing. So even they see all these things about doing, everybody can't have a George in their pocket and be able to, because that requires minimums. And a lot of people don't have $250,000 minimums to dump into an account every year. So they got to figure it out themselves. Yeah, and that's where I come in as a life insurance agent, as a broker. I come in and I tell them, listen, we can do all these things that you want to do, but it's going to take some sacrifice. You have to pay a premium.
Right.
You got to stop telling me that you want $200,000 in cash value in your policy next year with a $100 budget, $1,200 a year, $2,400 in 2 years, and you want a $200,000 return.
Yeah. As the new kids say, the math ain't mathing, right?
Yeah.
It's not mathing. Yeah. I mean, George, if you know something.
If you
know something, let me know.
I don't know no secrets.
I got $1,200 to give you every year.
All I know is
but I don't know about it.
Yeah.
But here's what I think the disconnect is, honestly, Lindsay. I think what the disconnect is, and this is in all of our industries, not just life insurance, but if people get on the internet and they'll speak to all these possibilities on what can happen, right? And so on the show, I would love to break this down, but like you hear people say, if you get a policy and you get a properly structured life insurance policy, but no one ever talks about the proper structure. Right? It's like, okay, well, don't show me the illustration on the theory, because I started out in the insurance world. I was a top agent for Mass Mutual. They still use my name to recruit Black people to this day, right? But my point is, it's like, if we can just educate people, right, beyond the sound bites, and like, hey, yes, life insurance can be a powerful tool. Yes, you can use life insurance to become your own bank. But here is what it looks like. because people are so misinformed and they don't understand. And it's not bad that there are premiums associated with it, that there are fees associated with it, because that's anything. But it's like, let's not oversell and undereducate. Mm-hmm. Right? So what I would love for you to do is to break down how the policy needs to be structured, right? And what it actually looks like to leverage it in real life.
I love that, because you're right. People just need to know the steps.
Right.
So if you are looking to become your own bank, infinite banking, this concept, the first thing you need to understand is it's going to require a commitment.
Right.
It is life insurance, and you must pay for the premium. There are 2 policy types that you can use to do this concept. It's either going to be universal life or it's going to be whole life. Now, both of these types have multiple variations, and some of them are going to get you to your goals faster, but again, goes back to budget. So you're going to first choose either UL or you're going to get a whole life policy.
Okay.
After you do that, you're going to want to maximize this policy's cash value growth so that you can reach these goals. So that means if your premium is, let's just say $200 a month, maybe you're going to dump in $350 a month, because you're trying to maximize the growth in the cash value. So that means, again, more commitment. The more commitment you give, the more money this policy is going to grow. But there is something called a MEC, a modified endowment contract. Right. Yep. So if you go over this number, that means the IRS deems this an investment, and it becomes taxable. So we want to stay under the MEC if you are somebody who is going to use the money. If you're transferring wealth and you ain't touching it, then it doesn't matter if the policy makes. But if you want to use this policy, then you want to make sure we stay under the MEC. So we're going to overfund this policy right under the MEC. So your insurance agent should be able to structure the policy and be able to make certain amounts of money be able to be dumped into the policy. After that, we're going to take money out for things that are going to be an asset. This is where people get it wrong.
Big facts.
You have to take the money out. Let's say you're purchasing a property that's $50,000 and it may need $20,000 in renovations. So you're at $70,000. So we borrow $70,000 from the policy, and now we sell this policy 6 months later for $150,000. You need to pay the $70,000 back. The goal of this thing is to repeat the process as you keep adding on assets. You're growing your assets, but your policy is becoming whole.
Yep.
So you're creating a bank per se, but the bank has to be funded.
Yep.
And so the problem is people come to me and they say, hey, I want to create a bank, but I have $50. Well, your bank is going to be relative to this $50 you have. I can't create you a $500,000 bank with a $50 commitment.
Yep.
Right.
It's relative. Now, the thing that happens in this policy is if you have time, which a lot of people, we don't have time. Everybody wants their money today.
Yeah.
So if you have time, then it will compound year after year, and it will look really nice later on. It will be 2-3 times what you probably put in. Your death benefit will be way more than what you put in, but not in the beginning.
Yeah.
So there are policies that you can put money in and get 85 to 90% out in year 1. But what will happen with those policies if you don't put the money back? It will end.
Yeah, it will come, and that money will become a taxable event.
Exactly. Yeah. So you can use the tool immediately. And one thing I want to say about that is if you're doing that, understand that it's a percentage of the money. Right. So you have to have the money.
Yeah.
So if you needed 100,000 and the percent is 80%, then you needed to put almost 120,000 in there.
Right. Yeah. I think the biggest misconception that cause people to look at life insurance as either a scam or something they don't need is they're expecting a miracle. And I think if you adjust your expectations to reality, it'll make the reality seem real. Because people, like to your point, I'll put $3,000 in the policy. How much do I got $15,000 next year? No, you don't.
Right.
If you put $3,000 in the market today, whether real estate investing, that's not going to happen. So I think you just come up with realistic expectations. And one thing that we joke about, but is real talk. Like, in my opinion, don't try to become your own bank until you have money in your actual bank.
Right.
Like if you don't got money in your Chase bank account.
Right.
Like, don't try to become your own bank over here because you just prove that you can't even keep money bank. Keep any money in a savings account.
Getting returned checks. Okay.
Crazy.
You're trying to set up. I've had people try to set up policies where they're trying to create $100,000 in 1 year, and it's bouncing. Yeah. How do you have a premium for $2,000 a month and it's bouncing? Something's not right with your financial plan. Why would you set yourself up for something for $2,000 a month and you don't have this money in there at least for 6 years?
Yeah.
Right.
Yeah.
Right? Yeah. Why would you set yourself up for a plan like that? And so I think the other issue is you have agents, and an agent is like a client in the beginning. They don't know, just like the client don't know. I'm telling you, when I train agents in the beginning, no, seriously, they don't understand the products either. They're learning too.
And I think that's the problem with the industry, though. No offense to the life insurance companies, but like, you don't need education to sell life insurance. You need to get your license, right? But then when you start with the company, you just go out and start selling.
They just put you out there.
They should make a requirement for you to understand the policy inside and out.
So they do have a process where you got to go through, but you know how that is. Yeah. You just got to learn enough for you to be able to pass this test, and then you're good. But that's not reality. When you go out and you talk to clients, you're going to deal with something different with each client. Yeah. So only experience can teach you that. Right. That's why when I started out, I had a mentor out the gate, and he was a multi-million-dollar agent, and he taught me so much that the company never taught me. Right. To this day, the companies have never taught me, and I'm a broker. So that's why I've set up the mentorship, because the game that I give these agents, they don't learn it at the company. And so now they're able to do a better job with their clients and be able, you have to educate the client. Because you know the thing, for instance, me personally, I'm not a UL lover because I don't like the unknown.
Yeah, me neither.
Right? I'm a whole life person. But I'm not pushing that on you as my client. As my client, I'm telling you facts. Whole life is a guaranteed death benefit, can have dividends, fixed premium. UL is a flexible premium, no guaranteed death benefit, no dividends. So I'm telling you facts. Both of them you can overfund. Both of them can be for retirement. Both of them can do everything if you structure it that way. The issue is, I don't want the unknown of the non-guaranteed death benefit. I don't want the unknown of not knowing what the cost of insurance is. Right. As a client, you really don't know that.
Yeah.
Right.
So when I sell you a UL, and I'm telling you, and I don't do this, but agents do this, they sell you a UL, and they're going to tell you you're going to have $200,000 a year in retirement. And guess what? Retirement comes, you don't even have $50,000 a year. You know why? Because you didn't put in the extra money. The cost of insurance raised. The index didn't perform like it said it was going to perform. The illustration was on 8% and it performed at 3%. Right. So I'm not dealing with that.